Imagine for a moment that everything you thought you knew about building wealth, about protecting your future, about constructing a portfolio that could weather any storm, suddenly became questionable. Not because you made a mistake, but because the world itself shifted beneath your feet. The rules that governed markets for generations, the principles that guided pension funds and endowments and individual investors alike, are now being tested in ways we haven't seen before. And at the center of this test sits a question that matters more today than ever. Is the 60-40 portfolio, that sacred ratio of stocks to bonds, still the anchor it once was? Or has it become a relic of a different era, one that no longer applies to the forces shaping our financial future? For decades, the answer seemed obvious. You put 60% of your money in equities to capture growth and 40% in bonds to provide stability and income. When stocks fell, bonds would rise, cushioning the blow. When inflation stayed low and central banks remained predictable, this balance worked beautifully. It delivered returns. It reduced volatility. It gave investors something they could understand and trust. But then something changed. The assumptions that made the 60-40 work began to crack. Interest rates fell to historic lows, then went negative in some places. Central banks expanded their balance sheets to unprecedented levels. Debt accumulated faster than economies could grow. And inflation, once dismissed as a relic of the past, returned with a force that shook the foundations of every traditional portfolio. If you're watching this because you sense that something fundamental has shifted, because you want to understand what role metals, real tangible assets like gold and silver, should play in your strategy today, then you're exactly where you need to be. This isn't about abandoning everything you've learned. It's about adapting to a world that no longer plays by the old rules. And if this kind of analysis helps you see the landscape more clearly, subscribe now so you don't miss the next insights and alerts we share. Because what comes next will determine whether you're prepared or exposed. The 60-40 portfolio didn't emerge by accident. It was born out of a specific set of conditions, a particular configuration of the financial system that existed for most of the late 20th century. To understand why it worked then and why it struggles now, you need to go back to what made bonds reliable in the first place. Bonds, especially government bonds, were seen as the safe asset. They paid a predictable coupon, they had a maturity date, and because inflation was largely under control and central banks had credibility, the real return on those bonds was positive. That meant that when you held bonds, you weren't just preserving capital, you were actually growing it in real terms, even if modestly. Stocks, on the other hand, carried risk. They fluctuated. They could lose value sharply in downturns, but over the long run, they captured the growth of the economy. Corporate earnings expanded, innovation drove productivity, and equity prices reflected that expansion. The logic of the 60-40 was simple. You held enough stocks to participate in growth and enough bonds to smooth out the ride. When one zigged, the other often zagged. That negative correlation, or at least low correlation, was the key. It meant that a diversified portfolio could deliver returns without exposing you to the full brunt of market swings. But that negative correlation was not a law of nature. It was a function of specific economic conditions: low inflation, stable monetary policy, and bond yields that were high enough to matter. When inflation was low, bonds could rally when stocks fell because central banks would cut rates to stimulate growth. When growth was strong, stocks would rise while bonds might soften slightly. The dance between the two worked because the backdrop was consistent. Central banks had room to maneuver. Inflation wasn't a threat, and the financial system, while complex, wasn't as leveraged or as fragile as it would later become. Now, fast forward to today. What do we see? Interest rates that spent years near zero. Bond yields so low that the income component The reason many people held bonds in the first place became almost negligible. And then, as inflation returned, bonds suffered not only from rising rates, but from the erosion of purchasing power. The negative correlation between stocks and bonds, the very thing that made the 60-40 work, began to break down. In moments of stress, both stocks and bonds could fall together, leaving investors with no cushion, no safe harbor. That's when the assumptions of the 60-40 started to unravel. This isn't just a theoretical concern. We've seen it play out in real time. In periods when inflation surprises to the upside, both equities and bonds can decline simultaneously. Equities fall because higher rates and inflation pressure corporate margins and valuations. Bonds fall because their fixed payments lose value in real terms and because central banks tighten policy, driving yields higher and prices lower. Suddenly, the diversification that the 60-40 promised evaporates. You're left holding two asset classes that are both vulnerable to the same forces, and that's a problem, a serious one, for anyone who built their strategy on the old playbook. The lesson here is not that stocks and bonds have no place in the portfolio. It's that the environment determines their effectiveness. In a world of low inflation, low rates, and central bank credibility, the 60-40 thrived. In a world of high debt, currency stress, and inflation uncertainty, it struggles. That's why the question is no longer whether the 60-40 is a good strategy in the abstract. It's whether it fits the world we're living in now. And if it doesn't, what should replace it, or at least supplement it? That brings us to metals. Gold and silver have always occupied a unique space in the financial system. They are not someone else's liability. They don't depend on a government's promise or a corporation's earnings. They are tangible, finite, and historically recognized as stores of value. In environments where trust in paper assets erodes, where currencies are debased, or where inflation threatens purchasing power, metals tend to shine. Not because they generate income or dividends, but because they preserve wealth when other assets fail to do so. Think about what gold and silver represent in the context of a changing portfolio strategy. They are not correlated to stocks or bonds in the way those two are sometimes correlated to each other. Metals respond to different drivers. They rise when confidence in fiat currencies falls. They rally when inflation surprises and central banks lose credibility. They act as insurance against the very risks that can destroy a traditional 60-40 portfolio. And that insurance becomes more valuable, not less, when the old correlations break down. This is where the conversation shifts from theory to practice. If you accept that the 60-40 may no longer provide the protection it once did, then you need to ask what assets can fill that gap. What can offer stability when both stocks and bonds are under pressure? What can preserve purchasing power when inflation runs hot and monetary policy is constrained? The answer, increasingly, is real assets. And among real assets, metals stand out because of their liquidity, their history, and their dual role as both safe haven and inflation hedge. Remember, this content is educational and not financial advice. Its purpose is to help you think more clearly about your own decisions. But the principles are clear. When the assumptions underlying a strategy change, the strategy itself must adapt. The 60-40 worked in a world that no longer exists. That doesn't make it obsolete, but it does make it incomplete. And understanding what to add, what to adjust, and how to position yourself for a world of higher inflation, greater debt, and more currency risk is not optional, it's essential. The erosion of the 60-40 isn't just about numbers on a screen. It's about the deeper forces reshaping the global economy. And those forces, debt, monetary expansion, geopolitical tension, are the same forces that make metals relevant again, not as a speculative bet, but as a foundational component of a resilient portfolio. So as we move forward, keep this in mind. The question isn't whether metals belong in your strategy. The question is how much and why now? Because the window to adapt is never open forever. And those who wait for certainty often find themselves scrambling when the shift becomes undeniable. To understand why metals matter today, you have to grasp what's happening beneath the surface of the financial system. It's not just about price movements or market sentiment. It's about the architecture of money itself, the way money is created, the way debt is managed, and the way central banks navigate the impossible trade-offs that they face. All of these dynamics have reached a point where the traditional tools, the levers that once stabilized markets and protected portfolios, are no longer as effective. And when those tools fail, the assets that lie outside the system, the ones that don't depend on promises or policies, become indispensable. Start with debt. Global debt levels are higher than they've ever been, not just in absolute terms, but relative to the size of economies. Governments owe more than they can realistically pay back through growth alone. Corporations are leveraged in ways that make them vulnerable to rising rates. Households are stretched. And all of this debt exists in a world where the cost of servicing it, the interest payments, can spiral out of control if rates rise too much. That creates a trap. Central banks want to control inflation, which usually requires raising rates. But raising rates too aggressively threatens to trigger defaults, bankruptcies, and a deflationary spiral. So they're stuck. They raise rates just enough to appear credible, but not enough to truly tame inflation. And in that middle ground, uncertainty festers. This is where the monetary dynamics come into play. When debt is unsustainable, there are only a few ways out. You can default, which destroys confidence and collapses the system. You can restructure, which is politically painful and economically disruptive. Or you can inflate, which means printing more money, debasing the currency, and eroding the real value of debt over time. Historically, the third option is the path of least resistance. It's less visible. It spreads the pain across a broader population, and it allows the system to limp forward without an immediate collapse. But it comes at a cost. The cost is the purchasing power of the currency itself. When currencies lose value, the logic of holding cash or bonds shifts. Cash, which pays no yield, loses value in real terms. Bonds, which pay a fixed coupon, also lose value if inflation runs higher than the yield. That's what we call negative real yields. And in an environment of negative real yields, holding paper assets becomes a losing proposition. You're earning less than inflation, which means your wealth is shrinking even if the nominal number in your account stays the same. That's the invisible tax of monetary expansion. And it's why people start looking for alternatives. Gold and silver are the classic alternatives. They don't pay interest, but they also don't lose value through dilution. There's only so much gold in the world. There's only so much silver. You can't print more of it. You can't inflate it away. And that scarcity, that finite nature, is what gives metals their power in an environment of currency debasement. When the supply of money grows faster than the supply of goods and services, prices rise. But metals, because their supply is constrained, tend to rise along with or even ahead of those prices. They preserve purchasing power when paper does not. This is not speculation. It's pattern recognition. Throughout history, whenever debt burdens became unsustainable and monetary expansion accelerated, metals rallied. In the 1970s, when inflation surged and the dollar was unlinked from gold, silver and gold soared. In the aftermath of the 2008 financial crisis, when central banks flooded the system with liquidity, metals rallied again. And in the years following the pandemic, when fiscal spending exploded and money supply expanded at record rates, metals responded. The pattern is consistent. When trust in paper weakens, demand for tangible assets rises. But there's another layer to this. It's not just individuals seeking safety. It's institutions, central banks, even governments recognizing the limits of fiat currencies. Central banks themselves have been net buyers of gold for years. They're diversifying their reserves away from dollars, euros, and other paper currencies. They're hedging against the very risks they help create through their own policies. If the managers of the monetary system are accumulating gold, what does that tell you about their confidence in paper? It tells you that even they understand the system is fragile. Even they are preparing for a world where trust in fiat money is not guaranteed. Silver, in particular, occupies a unique position. It has the monetary properties of gold, the history, the recognition, the role as a store of value, but it also has industrial uses. It's a critical component in solar panels, electronics, medical applications, and emerging technologies. That dual nature means silver responds not only to monetary stress, but also to real economic demand. When industries need more silver, supply constraints can drive prices higher. When investors seek safety, demand surges, and because the silver market is smaller than gold, these moves can be more pronounced, more volatile, and more explosive. The current environment is setting up precisely this kind of dynamic. Inflation remains a concern, even as central banks try to manage expectations. Debt continues to grow. Currency markets are showing signs of strain. And industrial demand for silver is rising as the world shifts toward renewable energy and technological innovation. On top of that, supply is constrained. New mines take years to develop. Production costs are high. And much of the silver that comes to market is a byproduct of other mining operations, which means supply can't easily scale up to meet sudden increases in demand. When you layer all of this together, the debt, the monetary expansion, the currency weakness, the industrial demand, the supply constraints, you see why metals are not just relevant, but essential in today's portfolio. They are not a speculative play. They are a hedge against the structural imbalances that define this era. And they offer something the 60-40 portfolio no longer can, true diversification, a position that benefits when the system shows cracks, when inflation persists, and when trust in paper erodes. This is not about abandoning stocks or bonds entirely. It's about recognizing their limitations in the current environment and adding assets that offset those limitations. The 60-40 was built for a world of stability. We no longer live in that world. We live in a world of debt traps, monetary experiments, and geopolitical fractures. And in that world, the role of metals is not peripheral. It's central. They are the ballast that keeps your portfolio from capsizing when the waters turn rough. They are the insurance policy that pays out when the traditional assets fail. And they are the signal, clear and undeniable, that something fundamental has changed. So when you think about the relevance of the 60-40 today, don't just look at historical returns. Look at the forces that made it work and ask whether those forces still exist. The answer increasingly is no. And once you accept that, the next question becomes obvious. What do you do instead? The answer lies in understanding the role of real assets, of tangible stores of value, and of positioning yourself not for the world that was, but for the world that is. That's where metals come in. And that's why they matter more now than they have in decades. One of the most important shifts happening right now is the breakdown of correlations. For decades, Investors could rely on certain relationships. When stocks fell, bonds would rise. When the dollar strengthened, commodities would weaken. When growth accelerated, safe havens would fade. These patterns weren't perfect, but they were consistent enough to guide portfolio construction. The 60-40 portfolio was built on these correlations. The idea was that by holding both stocks and bonds, you could smooth out volatility because the two would move in opposite directions when stress hit. But that relationship is fracturing. And when correlations break down, diversification becomes much harder. The reason correlations are breaking down is because the underlying drivers have changed. In the past, when stocks fell, it was usually because growth was slowing or corporate earnings were disappointing. Central banks would respond by cutting rates and injecting liquidity, which would boost bond prices. Bonds would rally, offsetting some of the losses in equities. That's the negative correlation investors counted on. But today, the risk is different. The risk is not just growth slowing. It's inflation rising while growth slows, a scenario known as stagflation. In that environment, central banks face a dilemma. If they ease policy to support growth, they risk fueling inflation. If they tighten to control inflation, they risk crushing growth. Either way, both stocks and bonds can suffer. We saw this dynamic play out recently. As inflation surged, central banks raised rates aggressively. Bonds, which are sensitive to rising rates, fell sharply. But stocks also fell because higher rates pressure valuations and profit margins. For the first time in years, investors holding a traditional 60-40 portfolio saw both legs of their strategy decline simultaneously. The cushion they expected from bonds wasn't there. The diversification they believed in failed to deliver. And that's when many started asking the question that should have been asked sooner. If stocks and bonds can both fall at the same time, what else should I hold? This is where metals enter the picture as a different kind of diversifier. Gold and silver don't move in lockstep with stocks or bonds. They respond to a separate set of forces: currency weakness, inflation expectations, geopolitical risk, loss of confidence in the financial system. When those forces intensify, metals tend to rise even when stocks and bonds are both under pressure. That's the kind of diversification that matters in a world of broken correlations. It's not about having two assets that move in opposite directions under normal conditions. It's about having an asset that performs when the system itself is under stress. Think about it this way. The 60-40 worked when the system was stable, when central banks had credibility, when inflation was low and predictable, when debt was manageable. In that world, stocks and bonds complemented each other because the shocks hitting the system were temporary and manageable. A recession here, recovery there, but always within a framework that held together. Today, the shocks are different. They're structural. They're tied to forces that can't be fixed with a rate cut or a stimulus package, debt levels that can't be paid down, currencies that are being diluted, geopolitical tensions that threaten global trade. These aren't temporary problems. They're features of the landscape we're navigating. And in that landscape, the traditional tools of diversification don't work the way they used to. You can't just split your portfolio between stocks and bonds and expect to be protected. You need assets that are uncorrelated to both, assets that don't depend on the health of the financial system, assets that thrive precisely when the system shows cracks. That's what metals provide. They are outside the cycle of paper promises and policy interventions. They are real, tangible, finite. And that makes them uniquely valuable in an era of broken correlations. Another way to think about this is through the lens of risk. The traditional view of risk in a portfolio is volatility. How much does the value of your portfolio fluctuate over time? The 60/40 was designed to minimize that volatility by balancing high volatility stocks with low volatility bonds. But volatility is not the only risk. In fact, it's not even the most important risk in the current environment. The more dangerous risk is permanent loss of purchasing power. The risk that your portfolio, even if it's not volatile, steadily loses value in real terms because inflation is eroding the currency in which your assets are denominated. Bonds in a inflationary environment are particularly vulnerable to this risk. They pay a fixed coupon in nominal terms, but if inflation is running higher than that coupon, you're losing purchasing power every year. And if you're forced to sell those bonds before maturity in a rising rate environment, you'll take a capital loss as well. That's a double hit. Stocks can offer some protection against inflation because companies can raise prices, but only if their costs don't rise faster. And in periods of stagflation, when growth is weak and inflation is high, stocks struggle too. That's the scenario where the 60/40 fails most dramatically. And it's the scenario that metals are built to handle. Gold and silver don't generate cash flow, but they also don't have liabilities. They don't promise a fixed return. They simply exist as stores of value. And in a world where the value of paper is uncertain, that's exactly what you need. They're not volatile in the sense of wild daily swings without cause. They're responsive. They react to changes in the environment, to shifts in policy, to evolving risks. And because they're not tied to the health of corporations or the creditworthiness of governments, they offer true diversification in a way that stocks and bonds increasingly do not. This is why the conversation about portfolio construction has to evolve. The old model, the one that worked for decades, was built on assumptions that no longer hold: stable inflation, central banks with room to maneuver, negative or low correlation between stocks and bonds, a financial system that, while complex, was fundamentally sound. Those assumptions are gone. We're in a different world now, a world where inflation is persistent, where central banks are trapped, where stocks and bonds can fall together, and where the real risk is not short-term volatility, but long-term erosion of wealth. In this world, the role of metals is not a nice to have. It's essential. They provide the kind of protection that the 60/40 used to offer but no longer can. They hedge against inflation. They benefit from currency weakness. They rise when confidence in the system falls. And they do all of this without requiring you to predict exactly when or how the next crisis will unfold. You don't need to time the market. You just need to recognize the environment and position yourself accordingly. The breakdown of correlations is not a temporary anomaly. It's a signal that the financial system is under strain. And when systems are under strain, the safest place to be is outside the system. Not completely, but enough to ensure that you're not entirely dependent on it. That's what metals offer: a way to step outside the cycle of paper and promises, a way to hold something real in a world where trust is fragile, and a way to ensure that no matter what happens next, you have assets that will hold their value when others do not. So as you think about the relevance of the 60/40, don't just ask whether it still works. Ask whether it's enough, ask whether the assumptions it's built on are valid, and ask what you need to add to your portfolio to truly be diversified in the world we're living in today. The answer, more and more, points to metals, not as a replacement for stocks and bonds, but as a complement, as the missing piece that makes a portfolio resilient when the old rules no longer apply, and as the insurance policy that protects you when the system itself is the risk. Let's talk about what resilience really means in a portfolio. It's easy to confuse resilience with simply avoiding losses, but true resilience is not about never losing money. It's about being able to withstand shocks without being forced into bad decisions. It's about having options when others have none. It's about positioning yourself so that you can adapt rather than react when the environment shifts. And in a world where the 60/40 portfolio is struggling, building resilience means rethinking not just what you own, but why you own it. The traditional portfolio was built for efficiency, maximum return for a given level of risk. That made sense in a stable environment where the primary concern was balancing growth with volatility. But efficiency and resilience are not the same thing. An efficient portfolio might perform well under normal conditions, but it can break under stress. A resilient portfolio, on the other hand, is designed to survive the abnormal. It sacrifices some efficiency and calm markets in exchange for protection when things go wrong. And right now, with the correlations breaking down and the system showing strain, resilience is more valuable than efficiency. This is where the role of metals becomes clear. They are not efficient in the traditional sense. They don't generate cash flow. They don't compound earnings. They don't benefit from productivity growth, but they are resilient. They hold value when paper assets falter. They provide liquidity when markets freeze. They offer stability when currencies are in question. And they give you the ability to act, to rebalance, to take advantage of opportunities when others are panicking or paralyzed. That's the essence of resilience. Not avoiding every downturn, but having the resources and flexibility to navigate through them. Think about what happens in a crisis. Markets fall, volatility spikes, correlations go to 1. Everything moves together, usually downward. In those moments, the 60/40 portfolio, which is supposed to provide balance, often fails to do so because both stocks and bonds are under pressure. But metals, because they respond to different forces, often hold up or even rise, not always, but often enough that they act as a true diversifier. They give you dry powder. They give you something to sell into strength when everything else is selling into weakness. And they give you the psychological stability to avoid making emotional decisions that lock in losses. There's another dimension to resilience that often gets overlooked. It's the ability to think clearly under stress. When your portfolio is being hammered and you don't have any assets that are holding up, it's hard to stay disciplined. You start questioning your strategy. You wonder if you should sell everything and go to cash. You lose confidence in your own judgment. But when you have a portion of your portfolio in assets that are performing well, even if the rest is struggling, it changes your mindset. You're not desperate. You're not panicking. You can assess the situation rationally and make decisions based on logic rather than fear. This psychological aspect of resilience is underestimated. Investing is not just about numbers. It's about behavior. And behavior under stress determines outcomes more than any spreadsheet. If you panic and sell at the bottom, no amount of theoretical diversification will save you. But if you can stay calm, think clearly, and act deliberately, you can turn a crisis into an opportunity. Metals, by providing that stability and that sense of security, help you maintain the right mindset. They're not just protecting your wealth in a financial sense. They're protecting your ability to make good decisions in a psychological sense. Now let's consider the practical construction of a resilient portfolio. The 60/40 was simple. 60% stocks, 40% bonds. That simplicity was part of its appeal. But simplicity is only valuable if it works. And in the current environment, that simple formula is no longer sufficient. So what does a more resilient portfolio look like? It includes stocks, yes, because you need exposure to growth and productivity. It includes bonds, but perhaps in a reduced allocation because their role as a cushion is diminished. And it includes real assets, metals in particular, because they provide the protection that bonds used to offer. The exact percentages will vary based on your circumstances, your time horizon, your risk tolerance, but the principle is consistent. You need diversification not just across asset classes, but across the forces that drive those asset classes. You need exposure to growth, which stocks provide. You need exposure to stability, which bonds can still provide in some scenarios. And you need exposure to assets that benefit from currency weakness and inflation, which metals provide. By combining these, you create a portfolio that can handle a wider range of outcomes, not perfectly, but adequately. And in a world of uncertainty, adequate is often good enough. There's also the question of rebalancing. In a traditional 60-40, you rebalance periodically to maintain the target weights. When stocks outperform, you sell some and buy bonds. When bonds outperform, you do the reverse. That discipline forces you to buy low and sell high. But in a portfolio that includes metals, the rebalancing opportunities can be even more valuable. When metals surge because of a crisis, you can sell some and buy stocks or bonds that have been beaten down. When metals lag during periods of stability and risk appetite, you can add to them at better prices. This dynamic rebalancing, driven by the different cycles of different asset classes, is what makes a portfolio truly resilient over time. It's also important to recognize that resilience is not static. The environment changes, policies evolve, risks shift. A resilient portfolio in one decade might not be resilient in another. That's why you need to constantly reassess, not obsessively, not based on every headline, but periodically you need to ask whether the assumptions underlying your portfolio still hold, whether the risks you're hedging against are still the relevant risks, whether the assets you hold are still positioned to do what you need them to do. This ongoing evaluation is part of the discipline of resilience. And here's a key insight. Resilience is not just about defense. It's also about offense. A resilient portfolio allows you to take advantage of opportunities that others can't. When markets dislocate, when valuations become extreme, when fear drives prices to irrational levels, a resilient portfolio gives you the ability to act. You can deploy capital into distressed assets. You can double down on long-term positions that have become cheap. You can shift your allocation to capture the next phase of the cycle. But you can only do this if you're not scrambling just to survive. And that's what resilience provides. The capacity to thrive, not just endure. Metals play a critical role in this. They are the foundation that allows you to be opportunistic. They are the reserve that gives you firepower when others are out of ammunition. They are the anchor that keeps you grounded when everything else is in flux. Without them, a portfolio in the current environment is fragile. It's dependent on a single narrative, the one where stocks and bonds continue to work together, where inflation stays low, where central banks remain credible. That narrative is under strain, and betting everything on it is a risk many investors don't realize they're taking. So when we talk about the role of metals today, we're not just talking about adding another line item to your portfolio. We're talking about fundamentally rethinking what a portfolio is supposed to do. It's supposed to grow your wealth, yes, but it's also supposed to protect it. And in a world where the old protections are failing, where the 60-40 is no longer enough, metals are the tool that fills the gap. They are the resilience you need. When the system is fragile, they are the stability you need when correlations break down, and they are the optionality you need when the future is uncertain. Building a resilient portfolio is not about predicting the future perfectly. It's about preparing for a range of futures. It's about having assets that perform under different scenarios, growth or stagnation, inflation or deflation, confidence or crisis. And it's about recognizing that the world we're living in today is not the world the 60/40 was designed for. That world is gone. The world we have now demands a different approach, one that includes real assets, one that includes metals, and one that prioritizes resilience over efficiency. Because in uncertain times, the ability to survive and adapt is worth more than the ability to optimize. And that's the lesson we need to carry forward as we navigate what comes next. The conversation about metals often gets reduced to price predictions. Will gold hit 3,000? Will silver break 50? These questions are natural, but they miss the point. The real value of metals in a portfolio is not about calling a top or a bottom. It's about understanding their role in a system that is fundamentally unstable. It's about recognizing that when the architecture of money and debt is under strain, the assets that sit outside that architecture become indispensable. And it's about positioning yourself not for a single outcome, but for a range of outcomes, many of which involve scenarios where traditional assets struggle. Let's be clear about what we're facing. The global financial system is built on layers of debt and credit that have grown far beyond what underlying productivity can support. This is not a moral judgment. It's a structural observation. Governments have borrowed to fund promises they can't keep. Corporations have borrowed to buy back shares and fund operations. Households have borrowed to maintain lifestyles. And all of this borrowing has been enabled by central banks that have kept interest rates artificially low and purchased assets to keep the system liquid. The result is a system that is fragile, dependent on continued intervention, and vulnerable to shocks that would have been manageable in a less leveraged world. In such a system, the traditional anchors of value become questionable. Cash loses purchasing power when central banks print. Bonds lose value when inflation rises or rates are forced higher. Stocks lose value when growth disappoints or when the cost of capital resets. There is no safe harbor within the paper system when the system itself is the problem. And that's why metals matter. They are outside the system. They are not a promise to pay. They are not dependent on a corporation's earnings or a government's solvency. They simply are. And in a world where promises are increasingly fragile, that simplicity, that tangibility is profoundly valuable. One of the dynamics that makes this moment particularly important is the concept of financial repression. Financial repression occurs when governments and central banks deliberately keep interest rates below the rate of inflation. This forces savers to lose purchasing power over time. It's a way of inflating away debt without calling it a default. And it's a policy that benefits borrowers, especially governments with massive debts, at the expense of savers and bondholders. In a financially repressed environment, holding bonds is a losing proposition. You earn a nominal yield, but it's less than inflation, so you lose in real terms. That's the hidden tax of low rates and currency debasement. This is the environment we're living in. Real yields, the yield on bonds after adjusting for inflation, have been negative or near zero for extended periods. And when real yields are negative, the opportunity cost of holding metals disappears. You're not giving up meaningful income by holding gold or silver instead of bonds. In fact, you're likely doing better because metals preserve purchasing power while bonds erode it. This shift in the calculus is one of the reasons metals have become more attractive and why they will likely continue to be attractive as long as financial repression persists. There's also the geopolitical dimension. The world is fragmenting. The post-Cold War order, where trade was global and the dollar was unquestioned, is giving way to something more multipolar and more contentious. Countries are rethinking their dependencies on the dollar. They're accumulating gold. They're exploring alternatives for trade settlement. They're weaponizing financial systems through sanctions and restrictions. All of this creates uncertainty. And uncertainty drives demand for assets that are neutral, that are not tied to any single country or currency, that are universally recognized as valuable. Metals fit that description perfectly. Central banks understand this. That's why they've been buying gold at record rates. They're not doing it because they think gold will go up in price and they'll make a profit. They're doing it because they want to diversify their reserves away from paper currencies that are being debased. They want assets that can't be frozen or confiscated. They want stability in a world that is becoming less stable. If the central banks, the institutions that manage the very currencies we use, are hedging against those currencies, what does that tell you about the system? It tells you that even the insiders don't fully trust it. For individual investors, the lesson is the same. If central banks are diversifying into gold, if governments are rethinking their monetary arrangements, if the system is showing signs of strain, then you need to be diversified too. Not in a panicked way, but in a deliberate, thoughtful way. You need assets that will hold value when paper does not. You need protection against the scenarios that the 60/40 portfolio was never designed to handle. And you need to recognize that the world has changed and your strategy must change with it. This is not about abandoning everything you know. It's about adapting to new realities. Stocks can still play a role. They offer growth and exposure to innovation. Bonds can still play a role, though perhaps a smaller one. They offer liquidity and some income, but neither stocks nor bonds can provide the kind of protection you need against currency debasement, financial repression, and systemic instability. That's what metals provide. And that's why they have moved from being a niche holding to being a core component of a well-constructed portfolio. Let's also talk about timing. Many investors wait for confirmation before they act. They want to see metals breaking out to new highs. They want to see inflation data that unquestionably supports their thesis. They want certainty. But by the time certainty arrives, the opportunity has often passed. Prices have already moved, premiums have widened, availability has tightened. The smart money, the money that understands cycles and structures, acts before certainty. It acts on probability, on pattern recognition, on an understanding of the forces at work. And right now, all of those forces are pointing in the same direction. The debt is unsustainable. The monetary policy is constrained. The correlations are breaking down. The geopolitical order is shifting. And the 60/40 portfolio, the strategy that worked for so long, is struggling. These are not speculative claims. They are observable facts. And when you add them up, the conclusion is clear. Metals have a role to play, not as a speculation, not as a trade, but as a foundational holding in a portfolio designed to weather the storms ahead. One final point on resilience. It's not just about protecting what you have. It's also about being positioned to benefit from the dislocations that are coming. When systems break down, wealth doesn't disappear. It shifts. It moves from those who were unprepared to those who are ready. It moves from paper to real assets. It moves from the complacent to the vigilant. And it moves from those who clung to the old playbook to those who adapted to the new realities. Metals are part of that adaptation. They are the tool that allows you to participate in the shift rather than being a victim of it. So as you think about your portfolio, as you consider whether the 60/40 is still relevant, as you weigh the role of metals in your strategy, remember this. The question is not whether metals will outperform every year. The question is whether you can afford to be without them in a world where the old rules no longer apply. The answer for most investors is no. You cannot afford to be without them. Not because of fear, but because of prudence. Not because of speculation, but because of structure. And not because of a hunch, but because of a clear-eyed assessment of the forces shaping the financial landscape today. The 60-40 portfolio was a product of its time, and that time has passed. The world we're living in now demands a different approach, one that includes real assets, one that recognizes the limits of paper, one that prepares for a future that will be defined not by stability, but by transition. And in that transition, metals are not optional. They are essential. They are the anchor in a storm, the insurance when promises fail, and the foundation on which true resilience is built. That's the reality we're facing. And the sooner you adapt to it, the better positioned you'll be for whatever comes next.